Investing is not that complicated. In fact, you can break it down into 6 steps. 1. Figure out what goal you're trying to reach. 2. Determine how much money the goal will require. You can choose from a myriad of online calculators to help out. And then, of course, you've got to see how much money you have available to fund that stated goal. 3. Measure how much risk you can manage on the way to achieving your goal. 4. Create an asset allocation plan comprised of different securities that act differently when markets zig and zag. 5. Stick to your allocation by rebalancing on a periodic basis. And 6. Shift that allocation as your goal nears or if circumstances in your life change. 6 steps, but only if it were so easy. The problem is that we are human beings, and as such, we have these darned emotions, and they can often lead us astray at the wrong times and make us lousy investors. In fact, research shows that the average stock fund investor has lagged the S&P 500 index by 4.2 percentage points per year over the last 20 years. The reason is easy to understand. When markets are soaring, people feel invincible. When they're plunging, fearful investors believe everything's going to zero, and they bail out. How can you avoid being a lousy investor? Start by coming clean. Take a look at your behavior. Over the past 10 years, have you been reactive to events, or have you been able to stick to your game plan? Do you have anxiety about your investments? Some degree of worry is fine, but you know the difference between a healthy respect for the volatility of markets and the anxiety that robs you of sleep. If you fear that you may be your own worst enemy when it comes to investing, there's no shame in seeking the assistance of a qualified financial planner. You can find one in your area at plannersearch.org. In New York, I'm Jill Schlesinger.